Alright guys, so let's get into the first price pattern, which is known as the head and shoulders. So what is exactly a head and shoulders and how can we trade it? So a head and shoulders pattern looks like this on the charts. Okay. Where this is the left shoulder, this is the head, and this is the right shoulder. So a head and shoulders pattern will always have two shoulders and a head, and the head will always be greater than the two shoulders, right? The peak will always be greater than the two shoulders. Next thing what we need to know is it will also always have this neckline where the bottoms are usually equal or they're connected by this neckline. We can label this the neckline. Now a head and shoulders can be drawn in multiple ways. One is like this. One can be on a upsloping trend line like this, and one can be on a downsloping trend line like this. Keep one more thing in mind, that it does not need to look like this precisely. What I mean by that is we can have the left shoulder be larger than the right shoulder, or we can also have where the left shoulder is smaller than the right shoulder, right? There's no textbook way to actually draw a head and shoulders. It's all about the underlying meaning. So when you see a pattern like this, which is the head and shoulders, this indicates bearishness, right? When we're in a, let's say in a nice uptrend, and you see this pattern form at the top of the trend, okay, this is indicating a trend reversal, a major trend reversal. One thing we need to know is head and shoulders don't form that frequently, right? But when they do, we need to be alert because they very rarely fail. And when they work out, right, they give a big move. So we need to keep this one thing in mind. Now, just like there is a head and shoulders, we also have the inverse of it, which is known as the inverted head and shoulders, or an inverse head and shoulders, right? With this as these two as the shoulders and this as the head. Okay, now this one, the inverted head and shoulders, is a bullish pattern, right? Usually you will see this in a downtrend and this forming at the bottom of the trend. So when you see this at the bottom of the trend, this is indicating a trend reversal to the upside. Okay, and this pattern can also be formed on a downsloping trend line and a upsloping trend line like this. Right? So these are the various ways a head and shoulders or inverted head and shoulders can look like on a chart, right? We'll be seeing many examples in just a bit, but this is primarily the ways this pattern looks like. Okay. Now let's get to the trading part. How do we trade this particular pattern? Now we need to keep one thing in mind, that this is a breakout pattern, right? Price patterns which repeat over history are nothing but breakout patterns. So if you see a head and shoulders formation like this, and this is the neckline, okay, means this is indicating bearishness, right? That price wants to go down. So if that is the case, we will only be looking to sell on the breakout, right? We will not be buying in this case because this is a bearish pattern. It's a negative pattern. Okay, so when do we enter? Now let's say this neckline is 100 rupees. So we will go short, meaning we will sell, right? We will sell the moment price breaks 100 rupees, right? So let's say price is currently trading at 101. So the moment it goes below 100, we will enter a sell trade. Okay, so let's say I will sell at 99.90 paise, just slightly below 100. Okay, now what will my stop loss be? Okay, a stop loss is nothing but how much you're willing to risk on a particular trade. Means if price goes above this level, let's say my stop loss is 110. So if price comes below and then goes back above 110, I will exit the trade at 110. Means I will book my loss at 110, right? About a 10 rupee loss. So that is what a stop loss means. Now we can also calculate targets based on this pattern, right? And we can set two types of targets. My first target will be the distance from the neckline to the stop loss, right? My first target will be the difference from the neckline to the stop loss. So the difference from the stop loss to the neckline is 110 minus 100, which is 10 rupees. So my first target will be 10 rupees, which can be at 90. Okay, and my second and final target will be the distance from the head to the neckline. Now let's say this value is 120, right? This is 120 rupees. So my final target will be 120 minus 100, which is 20 rupees. So my second target, final target, will be 80 rupees. Okay, I hope this is clear. Now many of you might be asking, how is it possible to sell first and then buy later, right? This is what we call shorting in the markets. So the stock markets allow this phenomenon where we can sell first and buy later, right? So that is called shorting, where without owning anything, we are selling first and then we are buying. Okay. Now maybe we can discuss this more in detail later. So I hope this is clear now. We will enter the moment it breaks below the neckline, right? Because these are breakout patterns. We will only enter on the breakout, not before, right? Not assuming that it will break, only the moment it breaks, right? So I will sell at 99.9. First target is the distance from the stop loss to the neckline. Second target is distance from the head to the neckline. That's it. The moment it reaches your second target, you can close your position. Okay, and it is exactly the same on the flip side, right? If we have an inverted head and shoulders, we will, this is a bullish pattern, right? So if 100 rupees is my neckline, I will buy the moment it crosses 100. So let's say I will buy at 100.20 paise, right? So what is my stop loss? This second shoulder low, right? The second shoulder low is my stop loss. So let's say my stop loss is 90 rupees, the amount I'm willing to lose on this trade. So now my target, first target will be the distance from the stop loss to the neckline, which is 10 rupees, and final target will be distance from the head to the neckline, right? So first target will be 110 rupees and final target can be 120 rupees. Now let's go see some examples on charts. So here, this is the chart of Nifty, right? This is the daily time frame of Nifty. So I can clearly see a head and shoulders pattern here. Now see, if you guys are beginners and you're new at this, it might take you some time to visually see it on the chart, right? But with time and practice, you know, things will start to become a lot more clear, right? Me having more than 11 years of experience, I can clearly see, I can immediately spot a pattern on a chart. It's just because I've had that much time and experience. So if we see this here, here's my left shoulder, here's the head, and here's the right shoulder, right? It's not that neat of a looking pattern, but it fulfills our criteria, right? With the left shoulder, with the head, and the right shoulder. Okay, so now what are my entry criteria? Okay. So I will enter here below the neckline, right? My stop loss will go above the right shoulder high. Okay, and now my targets. So now my first target will be the distance from the stop loss to the entry point. So about 232 points here, exactly, right? So this is the daily chart, guys. So my first target was achieved in 2 days, right? This was the day we would have taken the entry, and my target would have achieved on the second day. Okay, this is how beautifully this pattern works, right? And now my final target would be from the high of the head to the neckline, right? We calculate that distance. And this target would have also achieved somewhere here, right? So in about 4 or 5 days, 1 week, your entire target would have achieved and you would have exited the trade right here. Okay, let's see a few more examples. So here's one. Here's the left shoulder, here's the head, and here's the right shoulder, right? So my entry will be on the break of the neckline. My stop loss will be the shoulder high, and my first target will be 255 points, which is right here. Okay, and final target would also have been achieved somewhere here. Let's look at another example. So here's the left shoulder, here's the head, and here's the right shoulder. So this is a inverted head and shoulders. So we are looking to enter a buy position, right? So we will buy on the breakout of the neckline here. Stop loss will go below the right shoulder low. And first target will be 190 points, which is somewhere around here. Okay, and final target is, let's see, 6800 all the way to 7600, right? 6800 to 76, so about 800 points. Okay, so all you have to do is add 800 points from here, from 7600, so around 8400, right? So anyways, our target would have been achieved somewhere up here. Let's see if I can spot any more. Now see guys, you can do this on any time frame. Okay, this is, we're looking at on the daily time frame. We can also see this, let's say, on the weekly time frame. Let me show you 2008, when we got that big fall, right? The housing bubble in the US. So now, as I said, we can also have them on upsloping trend lines. So now if you see this, this is the weekly time frame of Nifty in 2008, right before the big crash, right? So in this case, my entry is right here on the break of this neckline, or you can even call it a trend line, right? I will enter short here, or I will take a sell entry here. This will be my stop loss. And you guys can clearly see that both the targets would have easily achieved. Right now, that's a really big target. That's a really big target. Okay, price almost halved, right? It almost went down in half. So this was a really big pattern, and it played out really, really well. You can see a big one right here as well. Left shoulder, here's the head, here's the right shoulder, right? And this is the neckline. So it's a beautiful pattern, guys. The only thing is the frequency is not as high. Okay. But when it does occur, it gives you beautiful moves. Okay. And we can also see this on stocks. I can show you one very simple stock, which is DHFL, where we recently got a big sell-off. Right. Let me show you the chart here. So we had the same pattern, right? The head and shoulders form right here. So this is the left shoulder, this is the head, and this is the right shoulder. Okay, so our entry right below this neckline, stop loss right above the right shoulder high. And if you want to see what happened the next day, boom, right? From 600, it went all the way to 260 approx in one day. So both of our targets would have achieved the same day. Okay, so this is the head and shoulders pattern, guys. One thing we need to keep in mind, as we go higher on the time frames, the significance increases, means the probability of it working out drastically increases. So the higher time frames are the better ones, right? I usually look at the daily time frame for these patterns, but you can also see the weekly and the monthly. Now keep one thing in mind, if we're seeing them on the higher time frames like daily, weekly, or monthly, our projected duration for the target to achieve will also be accordingly. Meaning, If I'm on the daily chart, right, I cannot expect for the target to hit the same day or the next day, right? I might keep a time frame of about 1 week or 2 weeks. If I'm on the weekly time frame, I might keep a target time frame of about, let's say, 1 month, right? So the higher the time frame means the longer it will take for it to achieve the target. Okay, now sometimes it happens very quickly, right? But we have to keep that in mind. The higher the time frame, the longer it will take for it to achieve its target. Okay, so if you're trading on the higher time frames, make sure that your trades will be positional trades, right? And not intraday. If you want to play these intraday, you can go on the 5-minute, you can go on the 15-minute, hourly time frames and trade this price pattern intraday. Okay, so this was the head and shoulders pattern, guys. Best thing I would suggest is open few charts and look for these patterns, practice them, backtest them, see how they worked out in the past and how they can play out in the future when you see them, right? These patterns work out beautifully. You know, I showed you on the daily time frame. If you want to see it on the hourly time frame, I can show you one quick example here. And this is Bank Nifty, right? Just how we have Nifty, there's also another index called the Bank Nifty, and we had a beautiful inverted head and shoulders form like this. And see what happened when we entered on the breakout here, right? In one, probably that same day itself we achieved the target. If not, the next day it gapped up and we easily achieved, more than achieved our target, right? So this pattern works beautifully, guys. Okay, so that's it for this pattern. Let's move on to the next one.